I'm Steve. Last time, we covered who gets into these funds and how they get paid. Today, we go deeper. We're going into the engine room. We're going to break down the specialized tools they use to engineer profits, often from pure chaos. Let's begin.
First things first, you have to understand the sheer scale we are dealing with. The industry is now pushing $5 trillion. This isn't some niche corner of the market. This is a force that moves and shapes the entire global financial system.
And make no mistake, this isn't a history lesson. This is happening right now, today. The strategies we're about to dissect are being executed on trading desks as we speak, moving billions with every single tick of the clock.
You know, the biggest mistake people make is thinking these funds just pick stocks. They don't. That's not the game. They operate with a highly specialized toolkit designed to find an edge, to find profit in the market's cracks, no matter which way the headlines are pointing.
All right, let's open up that toolkit. First up, the absolute classic equity long/short. This is the bread and butter of the hedge fund world. Really the original blueprint for how to hedge your risk.
So what's the goal here? Well, it's all about neutralizing something called market beta. Just think of beta as the tide. When the tide goes out, all the ships go down, right? Market beta is the risk that the entire market drops, dragging even your best ideas down with it. A long-short manager's job is to make that tide completely irrelevant.
So how does this actually work in the real world? Let's say a manager is really bullish on the future of AI, but they're nervous about a tech bubble. Instead of just buying the whole sector, they execute a paired trade. They go long on the strongest AI company, the one they believe is the winner, and at the same time, they short the weakest competitor, betting its stock will fall.
And this is the absolute key. Even if the entire tech sector crashes by 10%, if their short position, that weak company, crashes by 20%, they still walk away with a profit. See? They've successfully hedged out the market's move. Their profit comes directly from their skill in picking the winner over the loser.
Okay, on to the second tool in the kit, global macro. Now, if long-short managers are surgeons, carefully dissecting individual companies, then the macro traders, well, they're the grand strategists, viewing the entire world as their chessboard.
And that really gets to the core of it. Macro traders are not focused on a company's quarterly earnings report. No, they are looking at the entire world map. They're tracking interest rate changes, commodity flows, geopolitical tensions. Their playing field isn't stocks, it's entire economies. They trade on massive catalysts, a shift in policy from the Federal Reserve, a sudden currency devaluation in Asia, a geopolitical shock in the Middle East. These are the events, the shock waves, that create opportunity for a macro fund.
You know, a classic theme for these funds is what's called central bank divergence. This is when the world's major economies start moving in opposite directions. One is raising interest rates to fight inflation, another is cutting them to stimulate growth. Macro funds place massive bets on these divergences, anticipating which currencies will strengthen and which will weaken.
And they amplify these bets with immense leverage. They can take a tiny, almost invisible move in a currency or a bond, and by borrowing heavily, magnify it into a colossal gain, or a catastrophic loss. This is a high-stakes game.
The third tool in the kit belongs to the hunters. These are the merger arbitrage specialists. They don't ride trends, they pounce on specific corporate events.
Their entire game revolves around capturing one thing: the spread. Let's say Company A announces it's buying Company B for $10 a share. Company B stock might only jump to $9.50. That 50-cent gap, that is the spread. And it exists because there's a risk the deal might fail.
So the play looks simple. An acquisition is announced. The arbitrage fund buys the stock of the company being acquired. And then they wait, ready to profit if and when the deal closes at that higher price. Their risk isn't about the market. It's a cold, calculated game of legal and regulatory probability.
And this is exactly why they thrive on drama. When a messy headline hits about a potential antitrust review, other investors run for the hills. But for an event-driven fund, that uncertainty widens the spread and creates the opportunity. A disaster for others is an invitation for them. So let's pull it together. We have the surgical long/short trade, the strategic global macro bet, and the opportunistic merger hunt. Understanding these isn't just academic, it gives you a whole new lens to view the market with. It's the first step to identifying the moves of smart money. Most people see a stock chart going up and down. A manager armed with this toolkit sees something completely different. They see a complex puzzle of relationships, of probabilities, and of inefficiencies that can be exploited for profit.
And this is the crucial takeaway. Once you understand these core strategies, you stop seeing the market as just random noise. You start to recognize the patterns in trading volume, in price action that signal a specific play is in motion. You begin to see the footprints that this massive institutional capital leaves behind.
So the next time you see unusual activity around a merger announcement or a currency that's moving against the grain, ask yourself, are you seeing noise or are you seeing the footprints of a fund putting one of these tools to work?
The game is complex, but it is not random. Pay attention, and you will start to see the strategy behind the headlines. Watch for the footprints. I'm Steve.